everyone, I'm Rick Bensignor. Today is Tuesday, July 27th, and welcome to this week's In the Know Trader Show. On tap this week in our trader education portion, we're going to take a look at some of the similarities in calculated bar values between the MACD study and Ichimoku, the cloud charts, and talk about them a bit and why they're in common and what they probably mean. In our market overview, we'll take a look at the Dow Jones, and then this week we'll concentrate on the financial space. So we'll take a look at the XLF, the Spider ETF that covers the financial sector, and then that relative to the S&P. So we get relative performance. And as I said, we'll look at financials, and here we've got, 12 to 15 or so of the biggest cap weighted names in the financial space to take a look at those one by one as we go through the charts. As a reminder to email me, it's rick@inthenowtrader.com, and the products that we have and offer on our website, In the Know Trader, is the weekly ETF Tactical Trader Report, comes out Thursday nights, reviews all the markets much more in depth than we do here, and then also gives you a new ETF trading idea each week and updates all other open ETF positions until they get closed out. We'll adjust stops. Occasionally we'll adjust targets, not too often, but stops we will move around, always closer to price. So as something works our way, we raise our stops to protect profits. And then also at the end of every month, for those who subscribe to the 7-Eleven monthly Spider Sector ETF report, you get a new fresh report that has tons of charts and my recommendations on how to allocate a portfolio of Spider macro ETFs that fall in the range of the 11 sectors of the marketplace, with the goal of not having less than 5 or more than 7 at any one time allocated to those sectors in order to beat the S&P. And we are now 11 months into it. We started last August 1st, so we're about to finish our first year. We are outperforming the S&P by 371 basis points in our first year. So we'll have final results at the end of this month, but for a very small cost, you can follow this portfolio, make the adjustments yourself, buying and selling these Spider ETFs in the proper allocations, and beat the market. And that is our goal. And of course, if you're a money manager for clients, a financial consultant, this is a terrific way to beat the market and do so at a very low cost, and that makes your clients very happy and much stickier when you can actually outperform the S&P and not say, well, we also had money here and here, and we're never going to match the S&P. At least the portions that you have allocated to stocks, you should be able to beat the market each year if you know how to do it. That's what we do for you, and that's our monthly Spider ETF report. Again, all that information is at inthenowtrader.com. Okay, let's talk about MACD and cloud charts and what the similarities are. So everybody is, if you're a technician, you're very familiar with the MACD indicator. It is the default values or the difference between a 12 period and 26 period exponential moving average that gets plotted against a moving average of that differential moving average, which is called a signal line, that has a bar value of 9. So basically you're comparing if you're above or beneath this 9 period moving average, and that helps determine the buy and sell signals in the MACD charts. Very similarly, cloud charts also use 9 period and 26 period bar values to calculate the first 2 of the 5 values that appear in a cloud chart. So let's just take a look at a chart here. Let me pull up here. Let's just get a brand new chart. So this low here on the left is the March 2020 low. So you're seeing everything since the good bull market here. When I put up, well, first we'll put up a MACD, and then we will put up Ichimoku. So the MACD has been generally bullish, but it's gotten flat for a while. Here's the Ichimoku chart. So again, the MACD is the difference between a 12-period and 26-period exponential moving average. And then that is plotted against the red line, which is the 9-period moving average of this blue line. And as, for instance, the blue line crosses above, that's a buy signal. If it's beneath the 0 line, and you get sell signals when you get any clear cut, these are all pretty darn close. Breakaway blue beneath red. So you haven't really seen much of that here. You have a fraction, but nothing special. And here's the cloud chart. And some of you are familiar with cloud charts and some not. But this week, we're gonna concentrate on the first two shortest lines of Ichimoku. So this magenta colored line, this bright pink, is a 9-period moving average of midpoints of a price bar. So it's not typically you'll see moving average calculated off of the close. This is the midpoint of each bar. So the high, the low, add them up, divide by 2 for each bar. And this is the 9-period moving average of those midpoints. And you'll notice that on this most recent leg up that started last November, all the lows have come to the 9-bar moving average. So the first support level of cloud charts is this line. It's called the conversion line. If we translate it from Japanese into English, Ichimoku is a Japanese technical study. The second line is a 26-bar moving average. So any of the pullbacks haven't even gotten as low as the secondary support line, but certainly since last November, any of the significant pullbacks stopped right on or near the first level support. That's how strong a market rally we've had since the bottom. And interestingly, again, the MACD uses 9 and 26 also. And so, you know, did Gerald Appel, who created MACD, did he take it from Ichimoku, which was created far earlier than MACD was? Now, to my knowledge, the answer is no. I don't know how Mr. Appel came up with 9 bars and 26 bars. They don't really correlate to anything in modern day technical analysis type of rules or input values, other than the fact it's what he happened to use. 9 bars, it's not a week, it's not 2 weeks, you know, it's not 2 days, not 2 days, it's not 2 weeks looking at daily, because that would be 10 days. And 26 also, it's not the amount of days in a month. It's kind of an odd number combination he came up with, if not after the Ichimoku study, and found value there. But I will tell you that 9 and 26 are useful values for the marketplace to look at, especially because they are the values for Ichimoku. And this is a very used indicator, and certainly what we call the eastern part of the world as compared to the western part. And more people use it in the western part now, simply because it's been, I was probably the most significant user of this model and taught it to institutional portfolio managers and traders for over 20 years on the street, and became known as kind of the expert and the one who understands this model more than anyone else. There have been books written about it. One of the books by a gentleman named David Linton, it's called Cloud Charts, was inspired by a speech I gave in 2004 at the IFTA conference in Madrid, Spain at the time. So he saw me talk about this model and said to me, "Rick, why don't you write a book on it? There is no really good book out there." And I said, "Nope. There's stuff I know about this model that I'm not going to put in the public domain because it's to my advantage and the advantage of my clients that this stays, you know, more as something I use and I don't." So he said, "Well, if you don't write a book, I'll write a book." I said, "Fine, go to it." And that is, you know, he came out with the book, and it's a good basic book on cloud charting. So here's, and again, we're just looking at spiders here. And take a look at, for instance, the Qs. So you're going to see a slightly different picture. And the different picture is that because the Qs have higher beta, they have on their sell-offs come past the magenta colored line, but notice that the last two times down of significance, February and May, it was the baseline, this second support level from the cloud charts that caught the bottom. And to me, it's not an accident. It's not happenstance that this is where the Qs bottomed. It's because those who are bullish, who understand that if you break through the first level of support, you often get to the second level, that's your next place to be a buyer. So while others were panicking out and weak-handed longs, mind you, this is only a 3-week sell-off, right? But those who understood this model knew that this was the area to come in and buy, knew that this is the area to come in and buy. So next time we get to, we know there's important support at around right now 348.5 and 333 in the Qs. And only if 333 breaks with any bit of, a decent amount, then you would next look for us to sell all the way down to the cloud. Otherwise, you know where kind of the support levels are. And when you've got the pink line well above the orange line, you've got a good, strong market, especially when you've got, the spread like this. And it's actually gotten a little stronger recently, and it got stronger because we made new highs, pulling up the pink line more significantly than you would pull up the slower of the two moving averages. Obviously, it makes sense. The shorter one's more reactive to what goes on in the near term. So just realizing that both MACD and cloud charts have 9-bar and 26-bar values that are very important. I'm not telling you to pick these as your standard moving averages, but if you know what other people are doing and large groups of people, you often can tell where you're going to find support and resistance. And just, on the flip side, let's take here something like, here's KWeb, which is, Chinese internet stocks, and they've been getting crushed recently. And you'll notice that the two highs were against the pink line, first level resistance. And also here, climbed up. You had a couple of breaks underneath. We didn't fall as far here, but getting back above and staying above tells you you're back in a bull market. This pullback here in late December stops against the baseline, turns around, makes new highs, and then everything starts falling apart, and especially over the last month with what's going on in China. So just, some, hopefully, some understanding into 9 bars and 26 bars and why they're useful in both MACD. These are standard default settings in both these studies, and they tend to use, same type value. So I think that's interesting and why it's valuable to learn them. Let's quickly go to taking a look here at macro sector performance year to date. And what stands out most to me, energy still is the leader. But if you recall, it's not that long ago that energy was up 45% versus the S&P, or 45% on its own, not versus the S&P, but it wasn't outperforming by 45%, but energy was up 45% this year, if not a little more. You've seen it's gotten hit recently. It's now only up 34%, and real estate's getting closer to 27. I don't think real estate's, it can still do better. I don't think it overtakes energy. I think it's probably getting darn close to be looking at energy again, especially in relative terms. So you've got your haves, and then of course you have your have-nots, which are your staples and your utilities, which are the big underperformers this year at 6 and change and 7% versus the S&P being up almost 19%. So again, I like to look at this fairly consistently to just get a sense of, which of the sectors over here on the left that just happen to be trading very similarly to the S&P. And then what are your big outperformers and underperformers? Helps to pay attention to that. Okay, let's go to charts now. Just quick market overview before we get into financials. Let's look at the Dow. So here's the Dow. This is current. So this week we've got an aggressive sequential 13 signal. Just implies that there's more risk to being a buyer in the uptrend at that point. Prior times we got a 2-week sell-off here. Here we kind of went sideways for a full quarter, and it's interesting that we've got another one showing up. We haven't even broken underneath the most recent uptrend line. So obviously we made new all-time highs even earlier. It was yesterday, but I'm always mindful of these as far as if this kind of gives me a clue. I'm not going to chase after stocks generally on new highs. If I'm going to buy anything, I'm going to buy stuff that's sold off and has exhaustion buy signals to the downside. Key support right now is close to 32.3, 32.4, somewhere right in there. You've got both the propulsion momentum level down to where this next support level is from trend line. So that would be if we were to sell off and make a multi-month low, that's where I'd expect support to be somewhere, 32,250 to 32,500 or so, something like that. XLF peaked about, 6 weeks ago with its ultimate high price, but notice a few weeks before that got an exhaustion signal, the first one off of the bottom that we made in 2020 to all stocks. So this is good signal of trend exhaustion. We've pulled back since. We are holding above this propulsion bearish level that, if properly broken at 35.13, would then say that we could get down to 31.66 to 30.90-ish. So this is, if we properly break this, first I'd look for some support here at the baseline from the cloud, which has nothing to do with these other models. And then secondarily down here, 31 and change to 30 and change. I sold out a quarter of my long-term holdings in XLF sometime in the last month to 5 weeks, after this signal came in the 36 handle. So, right into here, I've taken off a quarter of my holdings. You'd have to get above 39.5-ish in order to really potentially get a breakout to the upside and kind of stop out the signal from this 13. Then let's take a look at financials versus the S&P. So you got the perfect top here. Not only was it against the lowest low of 2019, and it's again a relative chart, so we knew there should be some resistance around there, but it timed perfectly with a DeMark upside exhaustion signal. We've sold off since. We're currently on a bar 8. I drew the Fibonacci retracement, and I have pretty high confidence that between the 38 and 62% retracement of this up move is where financials are going to bottom. So next week, barring a really big outperformance, we'll do a 9 count. I prefer to see the 9 count actually make a new low, and anything down in here is where I'm going to start putting financials on again. Also, you've got this level here. So let's make this just, this high and this high in here is where we're also getting close to. So somewhere in and around here too, you'd expect to see support just from that's where we broke out from. So from both a Fibonacci retracement point of view, from a timing point of view, unless you think rates are going way back down underneath 1% and significantly beneath 1%, then I'd look at this as being in the next week or two, you start coming back into financials, especially if they make new lows in relative terms of new lows of this down move, and you get yourself into this section here. All right, that's it for the macro stuff. Now let's go into individual names in the financial space. We're going to start off with Berkshire Hathaway, BRK. These are the B shares, which trade at a fraction. I think they're 1/10 of the full price. So in the last week or so, we have broken underneath this uptrend line, which didn't come from the 2020 lows, but came from the last fall's lows, but it kind of seems like it's the right line. So in and around here is important. I'm going to blow this up a bit so you can also see that all these sell-offs still haven't properly broken 276.88. We have closed beneath it, but it came on a week after a down close, not an up close. Therefore, it was not a qualified break. It still shows support. Even this week's low is against that level. So Berkshire Hathaway is holding where it needs to. Now, if this Friday closes above last Friday, and then next week we close beneath 277.05, and the following week opens lower, closes lower, and takes out next week's low, then you've got a pure sell signal with a 259 initial target and a 227, let's call it 228 secondary target. So that's Berkshire. On the upside, look for resistance 295 and then near 320. JP Morgan. Aggressive sequential, standard sequential, upside exhaustion signals right near the top. This too, hanging out right near its line. The bearish propulsion level of 150, 140. If that properly breaks, look for 135. And then, if it kept going all the way down to, let's say, the 200-week moving average at 116 would be your next level. Upside resistance, 165-ish, and then 172. And if that breaks out, then the mid 180s would be next on the upside. Bank America, top, similar thing. Aggressive and standard sequential signals, 8 count down. A lot of these are looking the same. We're beneath the propulsion level, but didn't properly get a signal. Next week, if this sold down towards 34.5, 34.75, down to 32.25, 32.5, that's your zone that I would look to do buying in. I do think the pullback in financials is likely temporary, more of so I think over time rates will go higher and that are getting much closer to a bottom. Wells Fargo, WFC, downside exhaustion signals last summer and into the fall, side-by-side 13s. Now we have 13s on the top, hanging out on its 200. It's pretty flat 200-week moving average. Nothing to do in here. First support is 36.75. Second is 32.33. On the upside, look for resistance 49.40 and then 54.5. Morgan Stanley. This has been running and doing better than most others. Let's see, down, up, close. So we haven't stopped out this 13 yet. Even though we're trading above it, this is by far the best one we've looked at of the group. And further upside targets is $1.50 higher from where we are at 97.63, and then all the way up at 111. Notice these, this actually got a signal. Well, it's got a signal as a sell, but never got confirmed from sequential. And this is why I use multiple models so that one particular model doesn't get me caught into doing something. I like to line up multiple ones to increase the chances that what I'm saying is correct. I give credit here that this is still moving higher, bouncing off its trend line. So first sign of, to me, of warning of anything would be to take out this June low at 83.91. Otherwise, this still is looking good. Upside targets, I mentioned already. Citi Group, 13's on the high. This is 13 for a buy last October. So, and these 13s came in right against the TDST line resistance. Similar type thing here on an 8 count. Next week should be a 9, although it could be very tight by canceling it. If next week we close above 68.45 next Friday, that kills this whole count. But you will have just simply bounced on the 200-week moving average. Not as clear-cut a picture as some of the other ones. Goldman Sachs. 13 top here. So look, this 9 down led to a 9 up. You can't do a 13 without doing a 9. So the 13 here, so the follow through pretty much top near there. We haven't really moved much at all in the last several months here. This needs to break above 401 to target 423. Last week was an up close, so if this week closes beneath 357-ish, which doesn't look likely unless we get, well, it's still early in the week, that could happen. If that occurs, then look for move down to 320. I actually got long myself. I got my daughter long down here near 200 as this kept holding and couldn't break beneath these propulsion bear signals. Failed bear signals ultimately become bullish signals. So we got long somewhere around there, and I've trimmed a little bit in here, which makes sense given the signals I've seen in Goldman's inability to move higher. BlackRock. 13s here back in October, go sideways for months, get a whole nother leg up. 13s and 9s now, we go sideways again. Obviously a stellar name. Right now holding on to support near 850. If that breaks, look for 785 and then support down near 707. Don't have many upside targets here because it's already done so darn well. It's blown through just about everything other than 935, let's say 920 to 935, nothing else on the upside without doing further work. So, one of the stellar names for sure. American Express. No 13s here, only 9 counts. So 9 bottom here, 9 top here, 9 sideways since, a little higher. So held where it needed to at 162-ish last week. If that breaks properly, then look for the low 140s. Otherwise, this still has targets at 181, 184, and 201 on the upside. Charles Schwab, 13s here, giving some clue of exhaustion of trend, goes sideways 6 weeks, pushes up one more time, gets to the stop out level, but doesn't properly break the stop out level. So you're still within the context of the 13 for upside exhaustion. Give this a couple more weeks, only on a 7 count. Most of the other names were on 8 counts already. Give this a few more weeks. If you get down towards 60-ish from the current 67 and change, possibly a place to do some buying. S&P Global. SPGI. 13 signal pullback. 13 and 9 didn't get confirmed till here. Was the propulsion, just same thing. From a pure trader's point of view, it's a minor short, and you'd stop yourself out somewhere in the 420s. But the downside's first initially 391, then 359, then 322 on a much bigger sell-off. And I think that's it. We are done for the week. We are out of time, and we got to most of the names. I hope you've enjoyed this week's show. I'm Rick Bensignor. Thanks for watching In the Know Trader.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.